poised to correct on the slightest bit of news.
This is Sky News Business, Australia's business channel. The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening and welcome to Your Money, Your Call. I'm Chris Gray. On tonight's property edition of Your Money, Your Call, how can you give yourself the best financial start possible in 2012? What should you be reviewing and when should you be making those significant changes? And what can you do to improve your current cash flow position? Also on tonight's show, how much are the banks willing to lend you and what type of loan product should you be using? Now, joining us on our panel of experts tonight is Justin Buvov of Intelligent Finance and Shukri Barbara, a property tax specialist. So if you've got a question about how to set out your property investing plans for 2012 from an accounting or a finance perspective, then please give us a call on 1300 30 34 35, or if you prefer, send us an email to property@skynews.com.au. Welcome to the show. And welcome to you guys. Now, Justin, we'll start off with you. I guess the front of everyone's mind, start of a financial year, interest rates. I know the RBA is not meeting till February, but what's on everyone's minds at the moment?
Yeah, pretty much people are expecting the RBA to drop rates by 0.5 to 0.75% this coming year. The issue is that we don't know how much the lenders are actually going to pass back on to the clients. So what the issue there is also, ANZ just come out last month where they said that even though the RBA may drop rates, we may not pass them on, but what we're actually going to do, we're going to take it one step further. Instead of announcing our rate cuts or rate changes straight after the RBA meets, we're going to make it a few weeks afterwards, so the second Friday of each month. So the issue there is they're basically telling the government that don't dictate to us how we price our loans.
And it's always a fine balance, isn't it? Because going through the GFC, when the rest of the European countries and the US were going through hardships, we're always actually not trying to bash the banks and say, well, you're the ones that have saved us. Yeah. So we kind of want the savings, but at the same time, we really want stability, don't we?
Absolutely, absolutely. And
yep.
That's what's going to happen in the future is, you know, the banks are going to change how they price loans slightly and not pass it on, and because they need to make sure that they're still profitable.
Yeah. Now, Shukri, I know you're dealing with both property investors and businesses as well, and so some people want the kind of the high interest rates for the savings. Obviously, the borrowers want the least.
Yes.
Where do you see things at the moment, and do you think we're at fair rates at the moment?
Fair rates as far as you can go. The banks are giving my clients a very hard time ever since the GFC started, and right through to now, the activity of clients have slowed down. They're no longer going out and getting the high LVRs on the loans for properties, investment properties, and I guess that's one of the reasons why things have slowed down a little bit.
Is it because the banks aren't giving it to them, or is it more that they're just nervous?
Both. But my clients are active clients, and they'll go out because they're getting mentorship as well. They will go out and they will do things if the opportunity is there and if the numbers are there in front of them. So if they have the cash flow or even a small amount to get them going without losing track of what their total strategy is, they will go for it. So if the banks help, they'll be in it.
Sure. Now, Justin, a lot of clients are obviously kind of keen to get the interest rate cuts, but at the same time kind of sometimes want the fixed rates as well. Yeah. Where are people sitting with that? Because if we are going to see quite a few cuts, then obviously maybe it's not the best time to fix, is it?
Well, fixed rates historically are normally slightly higher than variable rates. What we're seeing in this market, fixed rates are actually a fair bit less than variable rates. So right now you can get fixed rates at up to about 0.5% below what you'd normally pay on your variable rate. So there is there's a good opportunity to fix, and for the next period of time till the banks actually pass on at least 0.5%, there's a period to get a cheaper interest rate. And the other thing is I look at fixed rates as being more like an insurance policy. So at least, like, yes, you may not win, so don't fix all your loan, fix half of it, let's say, and at least you've locked in the savings on half your loan and part of the variable rate. If the rates go down, you'll get the benefit of being on the variable rate. If rates go up, at least you have the insurance policy of being on the fixed.
And that's the way to think of it, isn't it? It's not necessarily what's the cheapest interest cost over the whole year. Is pay a premium, pay a bit of money to get the insurance policy, and at least you've got a guarantee.
Absolutely.
How long would you recommend the term to be for the fixed period?
Okay. We're looking at either 1 year for clients where if they think that rates are going to drop over the next year or so, then fix for 1 year, so at least they can protect themselves for 1 year, get like 0.5% less, and then in 1 year's time refix it at a lower rate. Or the other option we say for clients is lock in 3 years. It gives you enough protection to just in case there's uncertainty in the market, but it also protects you long enough that it doesn't lock you in long enough that in 3 years' time you can always get out of it if rates start to drop further.
Now, obviously, January, first week of the year, New Year's resolutions, there can't be a better time to get yourself a financial plan. What are some of the things that people should be looking for?
Chris, generally speaking, from my point of view, the best time to plan is about June. Okay, for the financial year, because then everything else falls within that. But January is a good time to review whether your financial plan has come out in the same way that you have planned it. So my first and foremost always objective is to ensure that you've got enough cash flow to keep going right throughout the year. Right? You're going to come to June, there's going to be some more decisions. Do you prepay for some people? Is the wife working? For example, I've got clients who've just decided to have children. Luckily for the professional clients, they get some support for baby support, so they've got some income coming through. But where that particular client I'm thinking of, they jointly own about 5 or 6 property, and he's continuing to buy. Right? And so the cash flow is going to be critical if she's not going to be bringing in the high income that she used to before.
And if you've got kids, you need to buy a small property because they're going to get very expensive later on.
That's exactly right. I highly recommend it. So these are the sorts of issues that you're going to look at. Then you've got to look at your ownership structures. Are they serving you? If you have a new opportunity coming up, are you going to put it in your own name, or do you need to look at the issue of trusts? What about asset protection? What about if it's cash positive, is it worthwhile to have the property in there so you can distribute to the family? So there's a number of these issues. So income capacity is very important, and loans in terms of facilities. If you get that opportunity, because as far as I can hear, the market is certainly going the investor's way. There's a lot of opportunities for cash flow positive, which everybody's trying to get. But is your affairs organised enough to access? Is your loan facilities organised enough to access that? So go talk to your property tax specialist and organise yourself. Make sure you're ready to pounce when that opportunity hits you in the face.
Because Justin, from a borrowing perspective, compared to now, say, versus GFC, is it easier to borrow now than it was before?
Pre-GFC, it was very easy to borrow. All you needed was the deposit. A lot of the lenders didn't even check what your income was. Yeah, absolutely. Then come the GFC, lenders just basically closed the door on lending, or most of the lenders closed the door and just tightened up. And some of them tightened up areas that were unnecessary. Over the last year, they've been easing that back. So lots of loans that previously they'd lend 95 to 100%, they wound that back to only lending 80% while they worked out where the market and what was a level value for a property. But now, for the right people with the right documents, it is easy to get funds.
But obviously, again, people need to budget, don't they? So whether they're on massive incomes or small incomes, you've still got to budget your money. How good are people at really doing that?
I find people aren't that good
Even
nowadays.
The accountants aren't necessarily good at doing it themselves at times.
No, that's true.
Yeah. So I think it's something that probably should be taught back at school days, that if financial management, budgeting, you're taught English, math, science and physics, but everyone has money and people aren't taught how to deal with that money properly.
And you brought a few budgeting tips with you, which we'll put up on the screen. And the first one was actually create a budget and stick to it, which is pretty elementary, but no one does it.
Absolutely. A lot of people that they'll have a plan to go on a diet, or they'll have a plan to do exercise. But one of the key things you need to do is make sure that if you're going to have a budget, stick to it, because there's no point writing it down and not following it. One of the other things is transfer. As soon as you get your income paid into your bank account, you should transfer as much as you can of that money into your savings account. So out of sight, out of mind. Then you're left with only a smaller amount of money. Use that to pay the bills and go have your entertainment, buy your gifts and whatever else you want. But at least straight from the beginning of the month, you're already saving some funds. Another one is pay off your higher interest debts first. A lot of people make the mistake where they want to pay off the highest loan first, like the highest dollar value first. So they start putting all their spare cash into the home loan, where their home loan's at 6%, credit card's at 20%. They should actually focus on paying their credit card off first.
And emotionally, that's better, especially if you get into really bad debt, because at least you can see that you're actually knocking off some credit cards and you're actually moving forward.
Absolutely. And one thing that people actually don't realise about credit cards is that if you haven't paid the monthly repayment or monthly amount that you owe on your credit card off in full the month before, the next month when you make transaction purchases, you don't get your 55 days interest free. You pay interest from day one of that purchase.
Yes, all the money you're paying into it actually pays off the last purchases, and the old historical ones, they're still accruing interest.
And you're paying interest. So it's just people have got it back to front. So that's another incentive to pay off the credit card debt in full every single month.
I wasn't sure about your next one of cutting back on drinking and
yeah, one of the things that people spend a lot of money on are drinking, smoking, and coffee. And one of my issues with coffee, while I'm not a coffee drinker, I always get knocked about this analogy, is people spend $3.50 to $4 for one of those takeaway coffees. They drink two or three of those a day, and when you work that out per year, they're spending about $2,000 of after-tax money just on coffee. And if you take that before tax, they're going to earn $3,000 just to pay for their cup of coffee. So that's, if they just knock out the coffee and drink the coffee they got in the office for free, it's not as nice, but $3,000 at the end of the year is probably a lot nicer.
And again, I guess the whole thing about this setting up a financial plan is a bit of sacrifice now, you reap the rewards later on.
Absolutely.
If I was given that advice, at least if there was I'm sure I've heard it before, but the key is to have a bit of mentorship to the 18 to 25-year-old groups. And when I was working in accounting earlier on, there was a young fellow who came in at 18. Right now he's a partner in one of the larger firms. And, he kept on his savings plan all this time. And you can imagine he's quite happy now with his kids and so forth. So yeah. I totally agree with what you're saying.
I've actually seen some very wealthy clients have like 15 boxes, and at the start of the month when they get paid, they say, right, this is our cinema money, this is our movie money, this is our drinking money. And literally, if there's no money in that little tub, you're not going to spend it. And they end up not actually doing it, and there's money over in all those things. So it's the basic things, no matter how wealthy you are, can obviously make quite a bit of sense.
Absolutely.
We'll jump now to an email, and we had an email during the week from Steve. And Steve says, I bought my main residence in 2005 for $162,000, and today it's worth about $290,000. Would I have to pay any tax in any of the three options I've listed? And would it be payable now, after I've subdivided and sold it, or in a few years' time when I actually sell the original house? Now, he says, I know you can claim the main residence only once, but if you subdivide it into two separate titles, does this mean when I sell the two separate title blocks, I can't state that I've held both as a main residence since 2005. Now, his options are, 1, subdivide the backyard, build a second unit and then sell both. 2, the second option is subdivide the backyard, build a second unit and then sell it, and then he remains in the front block as his main residence for a few more years. And the third option is subdivide the backyard, sell it off, and as I remain in the front block as my main residence, maybe stay there for a few more years. So obviously, slightly complicated situation there, but there's probably no black or white answer. What are some of the things that Steve should be thinking about?
Look, one of my clients sent me quite a similar question from Western Australia. The key behind deciding whether you should subdivide or not, or sell or not, you're starting off with first a commercial decision. How much is the value of the new properties that you're going to end up with? Okay, then we start to have a look at, say, okay, what about the tax issues that arise from whether you're going to sell or not? The key principles are like this. If you subdivide the property you're living in and immediately sell the land, the vacant land that you've subdivided, it's considered to be realising a capital gain, and there should be no capital gain tax in that instance. From that point on, if you make any changes, it depends on what is called your intention, right? And intention is critical in determining the answer to this question. So if your intention is to develop and resell, then you're carrying on the business of development, and the profit you make out of that is going to be subject to tax, okay? And so the key is going to be this. I think one of the issues is also, what happens if I just subdivide the land and leave it? Well, it's a bit grey. Sorry, Chris. But the key is the tax office will say, well, why did you go into subdivision if you didn't intend to actually do something commercial with it? And the key is going to be, well, okay, my recommendation is you subdivide immediately before you sell. That way you'll walk out with no issues. The other alternative is this. You can sell the house you're living in. Because it's your main residence, there will be no tax at all. And if you build the house on the next property and you move into it, then that will be your main residence at that point, and so there will be no tax for a little while longer as well. And the key is there is no tax until you actually sell.
Yeah. And the main thing again is things are always changing, but get all the advice before you make that decision.
Totally.
Because once you've made it, it's too late and it's set in stone.
It's very hard to step back, quite true. It's very hard to step back.
Yeah. After the break, it's time for Tip of the Week and more questions and ideas on property.
I love flying. Every minute counts, huh?
Sure.
I bet you're thinking you wish you had more people on the ground.
Exactly. Someone who could help me in every country would be good.
I'm thinking maybe you already do.
With business bankers wherever you're doing business, no one connects Australia and Asia Pacific like ANZ.
I think I might watch a TV show.
Oh, I know a good one.
What makes the BMW Summer Sales Drive better than other sales? Better offers on a better range of cars. The BMW Summer Sales Drive. Secure substantial savings on 2011 plated new and demonstrator run-out models. Drive now, live now.
Welcome back to the program. Tonight we're joined by Justin Dubov from Intelligent Finance and Shukri Barbara from Property Tax Specialists. If you've got a question about how to set out your property investing plans for 2012 from an accounting or finance perspective, then give us a call on 1300 30 34 35, or you can always email us at property@skynews.com.au. And now it's time for Tip of the Week. And this week's tip is 80% of the result is just from turning up. Now, when it comes to building a property portfolio, it seems like a massive task and so many things to do, but it really only takes the decision to do it. The rest of the pieces of the puzzle will generally just fall into place. Now, if you want to get fit, which a lot of people do at this time of the year, the hardest thing is getting out of bed consistently every day. Actually driving to the gym and doing something while you're there is reasonably straightforward, and generally the results will follow, hopefully. Now, with real estate, the first step is going to be to go and see your bank or your broker. Getting the required documents together can be a bit of a hassle, but if you ask them to push you along and kind of mentor you, it won't take long till you actually got your loan approved. And as an investor, there's no need to be an accounting and tax expert either. Again, a simple visit to a property tax specialist is all you need to do. You concentrate on the big picture of buying, and they deal with the detail and the paperwork. And when it comes to finding that property that's right for you, again, there's no need to spend months and months of long weekends hitting the streets and dealing with the real estate agents when a buyer's agent can do it all for you in a fraction of the time. Again, it might cost you a few dollars to actually pay someone else to do it for you, but they'll often get you better investments for less money, so they actually pay for themselves in the long run. Now, the old cliche of climbing a mountain all starts with the first step is very true in real estate. If you do want to change your financial future, it really does only just take a decision to do it, and the rest of the things do fall into place. You just need to work out how much you really want it, and you'll find a way to overcome any hurdles that put you in your way. Now, to understand more about any of my tips of the week, they all come from my book, The Effortless Empire. You can download it absolutely free. Just go to yourempire.com.au. Now, Shukri, probably the old days of going to the accountant, of giving them a shoebox full of receipts, I'm sure that day's still here. How many people know nothing about accounting and literally just give you all their receipts and you do all the rest?
They do. Look, there are some people still like that. I obviously don't encourage it. And what I do to circumvent that is we send them a checklist up front plus templates where they can complete them and give it to me in a summarised format. That saves them a lot of money, saves us a lot of time in trying to complete all the work, and makes it quite a lot. You've got to remember also the tax office has a lot of the information already on their website these days, so we're just matching information so that we don't fall foul, we don't get an audit from the tax office. And generally speaking, we will say to people, look, we'll show you either use an MYOB program or an Excel program or something like that. Compile all the information, much easier for the accountant to follow through with that.
So if you want to save some money, then it's nice and easy. But again, if you want to delegate the whole thing, you can just pass it all over.
We're happy to take it on, but people just got to be aware it's going to be costly.
Yeah. And Justin, when I started investing 20 odd years ago, trying to get an investment loan, they almost weren't around in those days. It was seriously hard work. Whereas now most people are used to using a broker and getting them to do all the work for them.
Absolutely. That's one of the reasons why the broking market has taken off. Is if someone walks straight into a bank, they've got to do all, the client's got to do all the running around for them, for themselves. Where if they go to a broker, the broker should, well, that's what we do, is we project manage the whole thing from start to finish. So we'll liaise with their solicitors, their accountants, their financial planners, their buyers agents, and we make it all happen. So
and the great thing is with a broker is you don't even pay them a fee.
Correct.
Yeah.
Correct. So
and it's the same price as going to the bank. Your
same price or cheaper.
Price.
A lot of the time we'll get it cheaper because of the buying power that we've got, and we're able to negotiate better deals than they could get direct.
Chris, one other thing in addition to that, I find that it's also great that not only is it facilitated, but it's recommended. You get to the professional who does the recommendation, which type of loan would suit your circumstances. That I find is a great help for us and my clients,
Because again, we're always talk about trying to pick the right brokers and the right type of accountants, because typically when you walk into a bank, generally you're going to get someone reasonably young and reasonably inexperienced, whereas typically how many different property investors would you be dealing with all the time, or percentage-wise, that are doing exactly the same thing all the time?
Yeah, we countless. Yeah. And what happens if someone walks straight, as you said, someone walks up straight into the branch, that person's not just selling loans, they're also selling banking products and insurance and all these other transaction products. So they're sort of a jack of all trades. We're the most knowledgeable people in the industry because that's all we do.
Because quite often if you go into a bank and they say, well, you're paying off your home loan, and you say, well, should I pay it off or should I put it into investments? Straight away they say, no, pay off your home loan. Whereas you straight away, you've probably had that question 1,000 times.
Absolutely. We'll make sure the structure's correct as opposed to just getting to make some silly decision.
And I guess New Year's resolutions, it's always a good time to review your loans and review your wills and finances. When should people be doing it? Is like once a year enough, or should they be doing it more than that?
Well, they should just, as a matter of fact, just do it once a year. But at any time that something changes throughout the year, they should also be modifying or reviewing their wills and insurances. Things like if they get married, divorced, if they take out a loan to buy a property, if they sell a property, have children, change jobs, all of those factors should allow them to review their wills and insurances, because a lot of factors change and they might not be in the right product at the time.
Now, when it comes to banking products, everyone's always talking about the cheapest rate.
Yep.
Is the cheapest rate the most important thing?
No, absolutely not. A lot of people make that mistake that they choose the cheapest rate product. If you go to a car yard, the cheapest car in the market's the Great Wall Chinese car, and not many people buy that. They'll buy a Honda, a Holden, or a BMW or a Mercedes. So people aren't buying the cheapest car, so why would you buy the cheapest loan? A lot of the time the cheapest loans in the market don't have the flexibilities that you need if you want to use that loan for future purposes or investing or make it more tax efficient. So a lot of the time the cheapest loans only allow you to have a variable rate. You can't have an offset account, you can't split it, you can't redraw, you can't put lump sums in it. So it's sort of you get what you pay for. So it's important to make sure you've got the right loan first. And what we actually recommend to our clients is the structure of the loan is the most important. So we'll map out the structure for the client, and then we turn around and work out which lender can do that structure at the cheapest interest rate.
So from a pure accounting sense, is it effectively a false economy? Not all the time, but some of the time getting the cheapest possible loan, because there's all these hidden other costs or taxes that you may be paying?
Well, anytime you do changes, there's going to be costs. I mean, you're going to come to the accountant to try and resolve what's going to happen afterwards. You've got exit fees. I know exit fees are now being cancelled by the government, but there's still some of the old loans carrying through. There's other fees as well involved, and the inconvenience of it all. Yes, you know, if you set it up right at the beginning, then you can run for 2-3 years without any changes. We usually recommend to people, as Justin was just suggesting, look, before you go into a new transaction, you come and talk to the accountant or to a property tax specialist just to see how it fits and suits the rest of your portfolio and what ownership structure you want, what lending is necessary, and the lending advice will come from the brokers.
Because in my parents' generation is you've got one banker and you go down, he's in the village. If you've got all your income going in and all your rents and all your home mortgage and your investment mortgages, and I give you bank statements with all of that just in one account, how much of a nightmare is that to go through for someone that doesn't know it to try and find out which bit is which?
It's the same as a shoebox. What I generally do is I send it back to them and I say, listen, could you mark every line and tell me what it's about? What is that payment? What is that receipt? Because otherwise it's just very impractical, you know. Again, it's a matter of
so you might save a few $100s, but it costs you $3 or $4 grand.
It'll cost them $1,000 or more, you know, by me having to get a bookkeeper to look at it.
Yeah. So what are some of the loan products that people should be looking at?
Well, fixed or variable, loans with an offset account. Pretty much every loan that we do has an offset account, and there's different tax treatments as to how offset accounts benefit a particular client.
So what's the main reason for going to an offset?
Okay, do you want to take that or should I discuss it?
Well, start and
okay.
I'll follow through.
Well, one of the reasons is a lot of people get a loan. If they want straight into a bank, they're getting the loan and they're told pay that loan off as fast as possible. The problem is if they've bought that property as, let's say, an owner-occupier, and they've paid down their debt, and at the end of 10 years they own the property, they've got no debt, they've got their title deed, and then they want to go and buy their house and turn that into an investment property, effectively they've paid off all their debt, so they can't claim any tax deductions off that particular property. What we recommend to our clients is have an offset account, because from a tax perspective, if you put all this, instead of paying the principal off on the loan, put the principal into the offset account, in the future when you go and buy your home, you pull the money out of the offset account, and that the full loan that you originally took out is tax deductible. So there's key benefits there that a lot of people, and this is why if they choose the cheapest loan, you don't get the offset account against the cheapest loan, and while you might save $100 a year for the first few years, after that you're going to lose tens of thousands of dollars a year worth of tax benefits.
Now, the common example, I've got a client at the moment who is working overseas in the Gulf area. He's very qualified. The contractor is giving him quite a lot of money, a lot of cash, and he has his house here in the northern suburbs. He has renovated it quite nicely, and then when he comes back, because his kids have grown up, he wants to go and live in a smaller unit. Now, because had he had an offset type loan account immediately, firstly, the amount of repayments that he has done the interest on that amount will still be deductible for him as he's overseas or as he comes in and lives in that extra unit. Another example is people who have either inherited money or the likes, and they want to, their family grew up, and they've already paid the existing home they're living in, but they want to buy a bigger house. But they want to rent this out because they've got this inheritance now. Now, the interest on the house that they have left is not going to be deductible. Had they had an offset type loan account, it would have been deductible. And there are countless other examples similar to that situation. It's when you draw money for private things.
And that's the way we've always been taught, or our parents were taught, is you buy a home and you pay it off.
Yeah.
But if you got that kind of situation, to quantify how much it would be costing you, $500,000 at 7% is $35,000, which is a tax deduction.
Yep.
That's a lot of tax back.
A lot of money back.
Yeah.
At 30%. Yep.
So 10 or 15 grand, and if you're worried about paying your accountant $500 or a grand for a bit of advice before, which everyone does, they don't want to spend the money in advance.
That's right.
But suddenly that's 15 grand a year forever for the rest of their life that they can't claim.
That's exactly right.
So a lot of money.
Highly recommended the offset type loan accounts. Before you go into a transaction, talk to the broker. Have the broker, I mean, I understand Justin does, and I certainly get calls from the brokers talking to me, and I usually push that point. Are they getting an offset type loan account to start off the program?
Yep. Now, does everyone need these kind of things, or are there situations where you should need it or you shouldn't need it?
What we tend to do is get most clients to take the offset account, because a lot of clients, when they buy their first home, they're up to here with debt, and they can never see themselves buying another property, let alone turning that original property into an investment property. The problem is that in the future, their position change. They may get an inheritance, they get married, and now they've got two incomes, and all of a sudden what was unachievable in their eyes is now achievable. They can turn that property into an investment property. So I believe that each person, when they set up their loans, have the offset account and have the structure correct, just in case you do it in the future. If in the future you decide not to turn the property into investment property, you want to sell it, no problem. You can take the money out of the offset account, put it straight back into the loan. But you can't take the money out of the loan and put it in the offset account and reverse it.
So flexibility, I think, is the key, and as Justin is saying, flexibility is the key for that exercise.
Yeah. And just to give the viewers idea that might be sceptical out there, I don't even ask my bank what they charge me. In terms of what I'm after that kind of flexibility and the ability to borrow more money than necessarily borrowing at the cheapest rate. So interest rate for me is probably the last question I actually ask the bank. Now, joining me on the panel of experts tonight is Justin Dubov of Intelligent Finance and Shukri Barbara from Property Tax Specialists. If you've got a question or want to join the discussion, give us a call on 1300 30 34 35 or send us an email at property@skynews.com.au. We'll be back in just a minute.
I wasn't born to be a footballer. I wasn't born to win a major. And I wasn't born to wear the baggy green for Australia. But I'll bet on any sport because I was born a Waterhouse. With 4 generations of betting knowledge in my blood, I was born to bet. Bet online with me at tomwaterhouse.com and let the knowledge increase your betting IQ. Any sport, any bet type, anytime. Join me now, tomwaterhouse.com.
Introducing the limited edition Mitsubishi Platinum range. All come with the comfort of leather seats, the convenience of Bluetooth.
Hello?
Are we there yet?
And the safety and parking benefits of a reversing camera. Plus, ASX comes standard with 16-inch alloys, active stability and traction control, and 7 airbags. Hurry, available for a limited time only.
Love that car.
Welcome back to the programme. Joining us tonight is Justin Dubov from Intelligent Finance and Shukri Barbara from Property Tax Specialists. If you've got a question about property and want some advice, give us a call on 1300 30 34 35. Now, we had another email during the week from Robert from Perth, and he asks, I'm recently separated and have a 950 grand home and 3 times 4 to 450 grand investments in joint names with my wife. They originally cost about 500 grand in the peak and have dropped since then, but I believe that they'll bounce back and they're worth holding on for the future. Should we sell and split the proceeds or keep? What are the accounting and finance issues to contemplate, assuming that we have them 50-50 and have around 85% debt against them? So I actually had a chat with Robert this afternoon about this, but I thought I'd bounce it to you guys as well.
Sure.
And see what your thoughts. So what are some of the things to consider there?
Chris, in this sort of circumstance, firstly, you've got to consider the relationship after the separation has happened. So if it is amicable...
and that's what they said. They're all amicable, okay, and they're agreeing with things at the moment.
Well, that's fine. In that case, what you should be looking at is the value. It's a commercial decision. What is the forecast growth rates for the properties there? If you're going to have a very high forecast growth rate, well, and you're happy to own jointly, there's no issues. I think you should, in my view, and I'm not the property expert, but I'm the tax expert, then why incur any other problems? If according to the example here, the property values for the investment properties have gone down, so there's no capital gains tax issues, but if you sell and rebuy other things, you've got stamp duties, a variety of other expenses, you would lose cash out of the deal. Whereas here you can use it as a base to borrow and move forward. Yeah,
because I think their property values at the moment are about 2.2, the debt's about 1.8, 1.9, so there's only about 300 grand's worth of equity.
Yes.
And so if you actually sell and rebuy, most of that will get lost straight away.
You lose a lot of it,
yeah. Now, what are your thoughts from a banking and lending perspective?
Yeah. Well, I think if it's amicable, my recommendation to the client would just leave everything as is from the investment side. If they want to keep it, leave it in joint names. The issue is going to be that because the lending ratio is at 85%, if they try and split the assets and you take 2, I'll take 2, they're going to have to pay mortgage insurance because both the loans, all the loans are going to be at 85%. So they're paying mortgage insurance for nothing. And the other thing is, if the wife's not working, or if one of the incomes, one of the client's incomes is really high and the other one's is low, the lower income earner may not be able to hold 2 properties by themselves. So I'd be looking at if it's amicable and they want to keep the properties, just keep them as is and get the accountant to sort out the tax side of it.
Now, one of the other things I brought up is when you're borrowing money in joint names, say if one of the partners in a few years' time decides to go and buy another property, and they want a loan in their own name, because they've jointly owned 1.8 million, in the bank's eyes, they'll actually see it as that individual owes the 1.8, because you might think individually, well, you owe 900, I owe 900, but if it's in joint names, the bank will actually see, well, effectively, you could actually be liable for that 1.8 million, couldn't they?
The benefit, correct, a lot of lenders do it that way. The benefit of coming to a broker is we've got lenders on our panel, we deal with over 40 of them, that will actually take it that if you've bought a property 50-50 and you've bought, let's say, a $2 million, you've got $2 million worth of debt and $1 million is only attributable to you, some of the lenders will only take $1 million worth of debt and half the rent.
Well, that's great news, isn't it? And that really is an advantage of going to a broker, because most of the time it was thought that other way.
Well, people go into their bank and the bank says, no, this is how it has to be done. And just because one bank says it can't be done doesn't mean another 39 or 40 other lenders in the market can't do it.
Yeah. And just to bring the other viewers in on the conversation, then one of the other bits of advice I was saying is that, look, certainly when you have a split up between partners and you're getting on, the best time to arrange something is now while you're getting on. What I'd say is, if you go through divorce, if you then have to sell the assets and rebuy them, that 200 or 300 grand is going to completely disappear and everyone ends up with nothing apart from the lawyers and probably the government in terms of taxes. So it's much better to come to an agreement now. Then what I'd say is bullet point exactly what you're agreeing to, and then have a worst case scenario. So effectively the worst case scenario is you're not even talking in a few years' time. What happens to the properties? Maybe they're kept for 7 years, then they're sold off at fair market value, and this is the way you split the proceeds. Get a solicitor to then draw up an agreement which may only cost you maybe $1,000 or $2,000, and then I think Shukri was saying before the program is that you can then take that to maybe a divorce court and then have actually that court approved to say, look, we both agree to this, we both think it's fair, we've had independent advice, and this is the way to go. Because certainly if you sell those assets, there's virtually no money left. The real value in that portfolio is 2 million of assets doubling to 4 million, still with 2 million of debt, you've made 2 million profit, you both end up with $1 million, which is certainly a reasonable amount of money. So again, definitely no right or wrong answers here, but certainly some of the options you should go through. Now, when it comes to LVRs with banks these days, is there a golden rule? Like in the old days, you could borrow 80% on a low doc or a no doc. Is it really down to income capacity these days?
Effectively, yeah. And prior to the GFC, some lenders would then lend 100% and some would actually lend 105% of the value of that property secured solely against that one individual property. Since the GFC, they've wound it back to about 95% plus mortgage insurance, which they'll add into it. But ideally, if you can put a 20% deposit down into the transaction, borrow 80%, and it avoids mortgage insurance altogether.
Now, another thing I was talking to Robert was that one option was to sell the family home or rent the family home out, but being $1 million property, rather than getting 4 or 5% yields, you might only get 2 or 3.
Absolutely.
If they say had one $2 million property, that might only get 2% yields.
Yeah.
How do the banks look at those as investments or even as homes? Is it one big asset is actually pretty risky for the bank?
Correct, and also when someone's trying to buy more and more assets, you ideally want to get as many assets as you can at the highest yields as possible. So owning lots of $2 or $3 million properties or $1 million properties with a 2% yield isn't attractive, and you're not going to be able to buy as many properties, and it's going to cap out because of your income.
And look, this is what we say to our clients, because our clients range from people on 50 grand incomes to people that might have hundreds of millions of dollars. We effectively buy the same properties for all of them. Yeah. So even the very wealthy clients, we don't buy $1 million properties. That's not necessarily something to aspire to. The 600 to 700 grand ones are the ones that have got the nice balance of capital growth and yields.
Yeah. And also, if you lose your tenant in $1 million property, it's going to hurt you more than if you had two $500,000 properties, you lost one tenant.
Yeah, so because there's queues of people for the 500 and there's not many for the million, which is why I rent. Right, coming on to some more of the other things when people are planning a new financial start is obviously land tax. One of the things is that people need to decide what state to buy in. Land tax obviously changes state by state. Do you want to give the viewers an idea of really what land tax is and how the percentages might vary?
Land tax is a tax levied by the state governments on people who own the land, whether it's people or companies or trusts, whichever the ownership structure is going to be. Generally speaking, when you have a trust structure owning the property, they can't tell who the actual eventual owner is, and so there is no threshold. Usually you have a threshold of land value before the tax is actually levied. In New South Wales, I think it's around the 387,000. Every year it changes and it shifts, but so do the values of the land. The valuation is done by the state government. Again, in New South Wales, it's averaged over 3 years, so that any peaks or troughs can not really hit you very hard. In New South Wales, the measurement date is the 31st of December. In Victoria, I understand it's the same. In Queensland, I'm not sure, but I'll guess it's the 30th of June. And the rates are quite different. New South Wales has the highest rate of 1.6%. In Victoria, it averages out at 1.3 above a certain amount, and certainly much lower when you compare it to New South Wales. Queensland also has a 1.65%, but that's after $1 million worth of land there. Now, I'm not quite sure how the governments in Queensland and Victoria value their land, but certainly something similar to New South Wales I would expect wouldn't be far different. But when you're looking at whether you should make a decision based on buying or selling based simply on land tax, it does take away quite a chunk of your rent. For New South Wales, for example, if you have 2 or 3 other properties and you've reached your threshold of $387,000, and then you're going to, on the next property that you're going to buy, you're going to pay the full amount of tax, you're talking about 1.6% of $387,000, the equivalent of nearly $6,000. So if your rent's only $20,000 to $25,000, well, that's about a quarter of the income just gone. Now, whether you decide to have it in New South Wales, you can, of course, balance out between the states. Because the states won't talk to each other on this basis, so you can have a property in New South Wales, a property in Queensland, a property in Victoria, and not pay any land tax at all. That question should come in on what is the profitability of each one, because you're in it to make money. What's the growth rate? What's the profitability? What's the bottom line at the end of the day? And you should make your decisions based on that after talking to, say, a buyer's agent to see what the comparable properties are.
Now, I know you've got a bigger picture than the average accountant, especially when it comes to property. The average accountant, when they're trying to sell their services to clients, they're always trying to justify their fees based on the amount of tax they're saving, aren't they? So a classic accountant might be of the opinion, buy this investment here because you save more tax or you're paying less tax. But it really should be the overall picture is, if you're going to get 10% growth in one state and you're higher land tax, who cares compared to paying no land tax and only getting 5% growth on another one?
10% on 500,000, is pretty good every year. You wouldn't want to miss that.
So you need to weigh up the whole picture.
You do.
And obviously it's tax deductible at the same time as well.
It is too, yes.
Yeah.
Yes,
so certainly trying to weigh things up. Just like what we're saying with the loans, sometimes it's a false economy moving interstate to go and buy something, and especially if you don't know kind of much about those kind of areas as well. Yeah. Certainly when it comes to borrowing more money with a lot of these products, if there's more expenses, quite often you borrow more money to help the cash flow. Once you borrow over 80%, do the costs get a lot higher in terms of interest rates, or is it just mortgage insurance?
Generally, lenders don't charge a premium for loans over 80%. But what they've actually started to do is a few of the lenders have actually started to reward clients if their loan is less than 75% of the value of the property. They're starting to give a bit of better discount as such. So it's actually effectively the lenders have got less risk with regards to that particular loan because it's a lower lending ratio, and they're passing some of that risk saving back onto the client.
Okay. Now, when it comes to first home buyers, for them to try and save 5% deposit, let alone 20%, is pretty tough when properties are $500,000 these days. What's your advice, or what do you need to contemplate, especially as a first home buyer, if you should borrow 80% or pay the mortgage insurance and go 90 or 95?
Okay. What we've found is some clients that have actually tried to save that 20% end up chasing the market. So they'll never get to that 20% mark, because as they get the 20% in the bank, the market's already moved. Now they need a little bit extra, So while no one likes to pay mortgage insurance and no one likes to pay fees that they don't want to pay, effectively mortgage insurance is a necessary evil. But there are other things and other ways that you effectively you can use, and other tools you can use to avoid mortgage insurance altogether. Some lenders, for the right type of client, will actually lend you 85 or 90% with no mortgage insurance. And
so what kind of circumstances would that be?
So long as you've got, they basically want a solid client. Stable employment, so same job for at least 2 years. they've saved their deposit, so the other 15% deposit, let's say it's a 85% loan, the 15% deposit that the client's putting into the transaction needs to be genuinely saved. So effectively, if they can see holistically that that client is a stable client, they want them as their client.
Because is it like the old professional packages? Like in the old days, being an accountant, you'd be seen as a professional, highly skilled, always have a job, you get a professional package discount. Whereas now, basically, if you've got a heartbeat, you can get a professional package, can't you?
Correct. And a lot of the time we get accountants or doctors coming to us saying that they've got, or solicitors, with this bank they get a 0.7% discount because they're a solicitor. And I was like, well, I can get you a 1% discount for not being a solicitor. So it's more so coming to a broker, we can show them different ways. Even back with that same lender that they do their daily banking transactions with, we're able to get them a better rate than they can if they went there themselves.
Just don't tell the kids at school that if they sweep the streets, they can get a bigger discount than the solicitor. Right, we're going to take a short break. We'll be back in just a minute, so don't go away.
I wasn't born to be a footballer. I wasn't born to win a major. And I wasn't born to wear the baggy green for Australia. But I'll bet on any sport because I was born a Waterhouse. With 4 generations of betting knowledge in my blood, I was born to bet. Bet online with me at tomwaterhouse.com and let the knowledge increase your betting IQ. Any sport, any bet type, anytime. Join me now, tomwaterhouse.com.
Looking to make a change for the better this year? Then look no further than a Battery World franchise. Battery World is the largest Australian retail network in the battery category. Do it for yourselves and your kids. Enquire today.
As we wait for Parliament to get down to business, APAC brings you the highlights from last year's question time that will shape the debate, policy and performance of our government in 2012. Screening exclusively on APAC.
Welcome back to the show. The experts are here to answer your questions about what's going on in the property markets. Give us a call on 1300 30 34 35. We've still got some time on the show. Now, credit scoring, whether you know it or not, you've actually got a credit score. How can you actually find out what your credit score is and if you've got a good or a bad one?
Yeah, one way of finding out a credit score is you can get a credit report, like Dun & Bradstreet or Vader Advantage. You can call them up, look on the website, and you can actually get it for free or pay $40 and get it turned around within 24 hours. And that will effectively show you how many, if you've got a default, hopefully you don't, if you've got a default, how many times you've applied for credit, how many times you've changed address, and all of that goes together because the lenders use that information along with what your income is, how much you're looking to borrow, and that creates a credit score. And so the issue with that is the lower the credit score, the more likely that your loan will actually be declined.
And so what are the kind of things that can actually bring your credit score down?
So if you've changed jobs frequently, changed addresses frequently, if you've had lots of inquiries on your credit report,
because rather than shopping around for, you might be shopping around for the best loan, but they might be thinking, well, you're getting turned down all the time. Absolutely. And you're after a lender of last resort or something.
Effectively, the credit reports, as they work today, only show how many times you've applied for a loan. If you've applied for 4 different loans, and the 5th lender's going to look there and think, you're coming to them, you must have been declined from each one. They don't know that you went to each one and kept shopping around for a cheaper rate. They'll just assume you got declined, and it'll work against you.
And again, this is where a good broker will actually go around shopping for the best result, but they're not actually getting your credit check, so it's not actually hitting your credit score.
So we do that for a lot of clients. We'll actually do the credit check up front and also sometimes order a valuation depending if it's, let's say it's a refinance. So we've got the credit score, the valuation up front, plus all the client's information. We then work out a list of all the limiting factors. So is it an income issue? Is it he's only been in his job for a certain period of time? We write a list of all the issues. We then road test it through all the different lenders through their credit department. So effectively, we take their application without submitting it and effectively get an answer from the lender before we've even submitted it. So before it goes in, we already know that it's going to be okay.
Now, what's it like for a first home buyer living at home with their parents, never borrowed a cent of money? Is that a good thing or a bad thing?
It used to be an okay thing. Now it's not so good because lenders previously would just look and say, you've got a deposit, you've got a job, that's okay. Now a lot of lenders want to get to know you. So what my recommendation is to ideally start saving your deposit and sometimes save it with two different institutions. Reason being, if you save it with one institution, in the future, only one institution knows you. If you've saved it with two institutions, gives us more options. And what we say to our clients and to parents of clients or potential clients, they introduce us to their kids a year or so before the kid's looking to buy a property. We then go through and work out who would be the appropriate lender for them to borrow in 6 months or a year's time, show them how to save, and their savings pattern meets what the bank's criteria is. When we put the application in, it's got a much higher chance of approval.
And then maybe even get a credit card and
Absolutely.
just put a few purchases through and pay it off every month so you're not paying any interest.
Absolutely.
And at least you've got a credit record then.
A lot of lenders now are looking to say, we want to have 6 months history with that particular client, and that could change. Just having a credit card or a bank account with that bank could change it between being declined and being approved.
Now we'll jump to the phone lines, and we've got Joe from Sydney on the line. Welcome, Joe.
Hello.
Hi, how are you?
Oh, good, thank you.
What's your question?
Yeah, I'd just like to know what's the best way. We've got we've pretty much got credit cards maxed out, and we just want to know what's the best way to pay them all off. Is it either release some money off your mortgage to help to do that, or?
Sure. No, good question. So you've got a bit of equity in your property, have you?
Yes, we have, yes.
Okay, well, we'll take it from both sides. Justin, starting off with you, so you've got some equity, but you've maybe had a bit of a run over Christmas, you've got some debt to pay off.
Yep. Yep, it depends, Joe. Joe, is the property an investment property or owner-occupied?
It's owner-occupied.
Owner-occupied. Okay, we'd still recommend that what you do is, if we pulled out equity out of the property, we'd create a separate loan split and use that account, and that interest rate might be 6%, 6.2%, 6.3%, pull that out, use that to pay off your credit card debt. And but the intention is, and the issue that you might face is, if you're paying off credit card debt, you may have a credit card debt of, let's say, $10,000, and you're amortising that and paying that off over a 3-year period by having that credit card debt. If we now refinance into the loan, they're going to spread that term over 30 years. So you need to make sure that while we can reduce your rate and reduce your monthly repayment, you ideally want to make sure you keep paying a higher monthly payment towards that loan, so you don't keep that credit card debt for 30 years. I want you to pay that off over 3 years.
And put that credit card back in the freezer or something like that where you don't use it.
Cut it up.
Put them all throw them away.
What about from your perspective, Shukri?
Look, you know, generally you're talking about credit card interest rates of you know, nearly 20% at some marks compared to 6%. It's a no-brainer. You really need to do it. The thing is, consult your broker, consult your accountant, so that you know what your structure is going. If earlier on we were talking about offset type loan accounts, lines of credits and the likes, then you need to review your situation. Being the beginning of the year will be a good point to start at that and see what the best option. Justin has just given a really good situation. You can take out a small loan or a split loan, as he says, and go with that. But it's important to have a look at the total situation you're in at the beginning of the year. But certainly transferring from equity and paying out a 20% sort of debt is a good idea.
Yeah. And Joe, look, from my perspective, it's all about doing stuff in balance. So the whole idea about using equity to pay off credit cards, while it saves you interest, is not necessarily a good thing for wealth creation, because you're basically spending your equity, but it's all in balance. If you're making 20 or 30 grand a year in capital growth over a few years and you spend 5 or 10 grand on having a bit of fun, I think that's all good. It's reinvesting in yourself, but obviously to do things safely. So thanks for that. Now, obviously for some people that want to try and increase income from properties, granny flats is a kind of a flavour of the last couple of years. Why have they really kind of come in, and what are some of the things to think about there?
Look, Chris, at the moment I'm getting people asking me, colleagues as well as clients, they're looking at things out of Western Sydney for about $185,000 to $200,000, large land, blocks of land with houses on it. And so if you're buying for $200,000 and if you rent it out, let's assume $400 a week, $300 to $400 a week, all of a sudden you have the opportunity to add another $45,000 and get another $200 in rent, so that's $10,000 a year. That's a pretty good return. So you get $600 out of $245. That's a very good return, almost you know, cash positive by any language, and that's where everybody wants to be. You want an investment property that's not going to cost you anything. Still, it's going to have some growth value in it.
And what's the difference between, say, having a granny flat in your back garden of your main residence that you rent out versus having it with the investment property? Is there a lot more complications?
The complications are always anything to do with those property. The main issue is capital gains tax. Now, if you're an investor and you had a granny flat, there is no issues. It all comes in under the same sort of umbrella. But if this is your mum and dad house and you've been living there, all of a sudden you decide to construct a granny flat and you rent it out, then when you come to sell that property, you've got a capital gains tax liability based on that granny flat as a proportion of the total land, a proportion of the total property. So you're going to come up to a point where you have to have a valuer estimate the value of the land relative to the granny flat and so forth. The complication comes up when maybe you've used it privately and then you've rented it out, then you've used it privately again. It's a matter of calculation. It's not a hard calculation, but it just takes longer, and of course it'll cost you just a little bit of fees to work it out.
Yeah, and so obviously record keeping is the most important thing.
Critical.
Trying to do it in hindsight is a nightmare.
Absolutely critical, because the tax office is always on to you. If you get an audit, it's a hard thing to do, but if you start off by maintaining all your records pretty good. If the records are hard to come by, get a quantity surveyor's report and just maintain it. All your purchase values for the property are in the solicitor settlement statements, whether it's purchase later on when sale. So keep all that, and if you're having a hard time, scan it. Keep it electronically these days, very good. Keep it with your property tax specialist, a copy there, because sometimes, you know, especially when you move or kids grow up or there's shifts in the family, you get to lose a lot of your paperwork. I know, because my girls now are running through my office at home. I certainly can't find some things.
Yeah. Justin, last couple of seconds on the show, what are some of your tips for young people out there wanting to make a start financial year? What should they be doing?
Don't let the debt get ahead of you. Pay your credit cards off always on time and in full, ideally. Save your deposit consistently. Always get in touch with your broker probably about 6 to 12 months before you're looking to buy, so at least they can prepare a plan so that you're finance ready in the future.
Yep. And Shukri, from your perspective?
From my perspective, the financial year, always review your position. If you're going to go into a transaction, talk to a property tax specialist. Just knock your heads. You don't have to make a big deal. Have an hour with them just to see where you're at, so that when you go into the transaction, all your things are ready. Your loan facilities are ready, your financial structure is ready, and that makes it just easier for you and the bank to finalise the transaction.
And also have a bit of a contingency plan. All this talk about Europe, if things do go wrong, you always need a backup plan as well.
Totally. You need to keep some money aside. You need to just not push yourself to the limit.
Yep. Well, that's all we have time for tonight. I hope you've enjoyed the show. Many thanks to Justin Dubov from Intelligent Finance and Shukri Barbara from Property Tax Specialists, who've obviously shared their knowledge and skills this evening. Now, next week, we're going to have more finance and accounting ideas for property buyers and investors. So I look forward to seeing you until next time. Till then, I'm Chris Gray. Good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. 2011 was one of the most tumultuous political years in living memory. What will the new year bring?
Australians will see how wrong and reckless he is.
Many doubt we have heard the last on the carbon tax, but who will win voters' support to keep or kill it?
We have to stop this tax.
What next for our asylum seeker policies as public opinion demands more compassion? Can Tony Abbott turn swinging voters' perception from Dr. No to yes, Prime Minister?
That's what Australia needs, an election.
And could Julia Gillard lead Labor to the biggest comeback in Australian political history?
We have governed well.
The issues, the policies, the power players.
Have you considered stepping down for the good of the party?
Politics you can't stop watching.
She's fighting for the survival of the government.
For unrivaled coverage of national politics in 2012.
No matter how ferocious the scare campaign, we will stay the course.
This is Sky News, Australia's news channel.
Tonight, Hollywood's biggest stars.
It is an experience akin to nothing else.
I'm trying to hold my breath. Welcome to Live from the red carpet. Penelope Cruz, George Clooney, Matt Damon.
I'm swooning over here. Did you really want to tell the world that? Why? carpet interview ever.
Let me see the back.
Look at that dress and let me hear you.
Oh my God!
E live from the red carpet, January through February, right here, only on E.
I love football because of the passion it brings. I love footy because of the tribes, the kids, the colours, the supporters going off their mind, the marks. I love football because when they can't get up, they get up. I love footy, live, in high definition, uninterrupted, siren to siren. I love football because it's the best thing that God ever invented.
Saturday night, what do Dave, Regis, Robin, Charlie, President Clinton, and Barbara Walters have in common?
We're actually shocked when she told us. I did a lot of praying.
They all went from being in the heart of the spotlight to open heart surgery.
This is the big one.
Now they all open up as never before.
Oh my God, I'm alive. What have I lived through?
Personal, emotional, funny.
Where did they get the new arteries from?
Ace Hardware.
It's a matter of life and death.
Saturday night on Sky News.
Your investments.
The time for action is now.
The focus here is on Australian jobs.
The internet has transformed the economy.
We've got a very interesting thing happening here.
The rally's great and let's enjoy it. We think it's a game change.
The power and immediacy of information in this day and age.
Qantas were bleeding to death.
I'm disgusted with what Alan Joyce has done.
Get this deal done.
The path back to respectability.
Breaking news, the Reserve Bank has just cut rates.
The ranks are getting thin out there, so we might as well go for comedy.
It's a long time between drinks.
Despite the storm clouds on the global horizon,
We're in for the fight of our lives.
We haven't identified what chemicals are being used in the fracking process.
You're big enough and well paid enough.
And that's a fact.
And the world's financial markets are focused here.
Very much poised to correct on the slightest bit of news.
This is Sky News Business, Australia's business channel.
Hello and welcome to the best of summer money, our highlights from the program throughout the trading week. Well, we started the week chatting to Century 21 Chairman Charles Tarby about the real estate icon's plans to beef up its business by acquiring listed property manager Wentworth Holdings. The two companies have joined forces to form a strategic alliance which combines Century 21's 300 real estate offices across Australia with Wentworth Property Management's expertise and on-site letting rights. It comes as the Australian property market faces another tough year, with global banking turbulence expected to affect house prices here and at home. Liz Tilley spoke to Charles about Wentworth's alliance with Century 21 and what to expect from the market in 2012.
In acquiring it, it means that bringing it back to the public arena, which is where I think property management should be. It should be shop front, it should be mum and dad style of operation, it should be local people dealing with local properties to help local investors, and taking it back and acquiring that business and bringing it back into my main company, Century 21 Australia, allows me to do that and distribute those managements accordingly.
Okay, sure. Some would argue that it's quite a tough time to be making acquisitions like this, though. Why now?
I think that's the best time, really. You get the better opportunities now when the market is tough, when the market's buoyant, everybody's out there, and I think prices often get inflated, and they then lead to times that we're in right now. So I think the acquisition was there. It was certainly moulded within my company. It fit perfectly within my business overall. And so I looked around at it, and I thought, look, it's good. It allows also, in terms of property management, it's a cash flow business. It's also managing landlords and tenants are future buyers. Landlords are investors and future buyers as well. So it really creates a